When politicians speak, markets respond. And they respond even when there's no concrete action taken by politicians. One of the best examples recently was the example of Mario Draghi, the ECB chief, who famously said in the summer of 2012 that he would do whatever it takes to save the euro. Those words have been among the strongest words that I've ever heard from a government official, or strongest in terms of their impact, because those few words basically pulverized the Eurozone debt crisis. Essentially, over the past 2 years, things have been getting better. Despite the lack of structural reforms, all you need is a government official saying, "I'll do whatever it takes," and these words have had a huge impact.
Uncertainty is a state of having limited knowledge. When you're faced with uncertainty, it's impossible to know precisely what's happening right now, much less what will happen in the future. For decades, researchers have been studying how uncertainty affects financial markets. But since the beginning of the financial crisis, they've become interested in a particular kind of uncertainty, the kind caused by governments and policymakers. The big question about this policy uncertainty is exactly how much it affects both financial markets and the broader economy. We know policy uncertainty matters, but how do we measure it? And how can we gauge its impact?
Because if you think back to the peak of the financial crisis in late 2008, early 2009, monetary policymakers and fiscal policymakers in the United States and around the world were confronted with difficult challenges unlike any they had faced for many decades, and really unlike any they had faced in the modern economy in countries like the United States. So this meant policymakers were facing dire circumstances. It was unclear exactly what the best policy response should be. Even if you agreed on what the policy response should be, there was a lot of uncertainty about how effective it would be.
Is the government going to bail out Lehman Brothers? Are they going to bail out General Motors? What are they going to do about in terms of reform, sort of even after the crisis? The reform of healthcare, the reform of Wall Street, the unconventional monetary policy that we've seen, all sorts of challenges in fiscal policy. In all of those, there was a tremendous uncertainty about what the government's going to do.
What does uncertainty really mean? Well, what kind of policy uncertainty? Are we talking about tax policy? Are we talking about interest rate policy? Are we talking about government expenditures? The basic story goes as follows. I'm a household, or I'm a firm at the current point in time, and I want to invest in a project, but I'm not sure if that project's going to have more benefits than costs at the current time. So if if uncertainty goes up, then my natural inclination would be to wait. Right? Why don't I wait a few months until see how the economy turns out, and then I can always continue with that project. And that might have, if individually, lots of individuals are doing that collectively all at one time, right? If systematically we're all making this wise decision to go wait to invest in the project, to wait to start, to wait to buy the business loan, to wait to go buy the next house. If collectively we all have that same decision, it's all optimal. It's optimal individually for each person. Collectively, it may not be optimal.
The market crashed, house prices tanked, and people began losing jobs as the credit crunch that began in 2007 became a financial crisis in 2008 and an economic downturn in 2009. At the same time, the White House changed hands, bringing in a new US president elected on a platform of sweeping change.
I think three of the biggest sources of policy-related economic uncertainty in the last several years have been, first, the financial crisis, the unusual challenges it presented policymakers. Second, the fiscal battles, often along partisan lines between Democrats and Republicans we've had, related to the fiscal cliff, extensions of tax cuts, sequesters, and so on. And third, the uncertainty about the political durability, the constitutionality, and the economic effects of the Affordable Care Act. So the common element of all of those is they've been fought along intensely partisan lines. There's been last-minute resolution, or sometimes even after the last-minute resolution, so that it was highly uncertain exactly which way things would fall out, and people had little advance warning for what the changes in government spending would be, what the changes in the tax rate would be. That is quite unlike anything we've previously had, at least in the post-war period, in the United States economy. And it's an example of kind of economic uncertainty that is inflicted upon the economy by the workings of the political system. So we define policy uncertainty broadly, and we're trying to capture three things. Uncertainty about who will be making decisions that have economic consequences, policy decisions. Uncertainty about what those decisions will be and when they will happen. And then uncertainty about the economic effects of policy decisions, both past and current and future, possible future policy decisions.
As researchers dig deeper into policy uncertainty, they're starting to create new subcategories and definitions, such as differentiating between political uncertainty and impact uncertainty, which is the impact of that political uncertainty on the economy and financial markets.
Lubos and I started thinking through, what really was actually political uncertainty or policy uncertainty. And you realize there are really two things that have to do with the politics and asset prices. One thing is you don't know what the government will be doing in the future. So we call that political uncertainty. In the future there could be some changes in policy regulation or banking structure or other things, and we don't know how the new landscape is going to be. And this uncertainty, because you don't know what's going to happen, and news about it is going to move stock markets. But the second type of political uncertainty, which we call policy impact uncertainty in our paper, but is more policy uncertainty if you want, is that even if we know exactly what the new regulation looks like, we don't know what the long-term impact is going to be.
Chicago Booth professors Pietro Veronesi and Lubos Pasta have written 3 papers together on the topic of uncertainty.
In the first study, we asked, how do financial markets respond to government policy changes? And we found that you should expect the stock market to drop on average when the government changes its policy. So if the government does the right thing, if they announce the right policy change, that's good news, and stock prices go up in response. But they don't go up by much because this good news has already been expected to some extent. We expect the government to do the right things, but if they do the wrong thing, not only is that bad news and stock prices fall, but the news will be unexpected. And so the negative price reaction will be a lot bigger than the positive price reactions. In our second paper, we ask if there's news about what the government might do in the future, how does that impact financial markets? So if a politician speaks, how do markets respond? When politicians speak, even if they don't actually do anything, when they speak, prices respond. And prices respond because when politicians speak, we're getting signals about what they might do in the future. So we're updating our beliefs about what the government will actually do in the future, and those future actions will have real effects.
We managed to we believe, to have a way to actually differentiate political uncertainty from economic uncertainty in a pretty neat way, and therefore document that political uncertainty is there and separate from economic uncertainty. It has its own risk premium, its only part, and this is an important step in the puzzle, an important piece in the puzzle, because it's really important to differentiate economic and political uncertainty having different risk premium. One important implication of showing that the political uncertainty has its own risk premium is that we also show that this risk premium is bigger in bad times. So think about it. Bad times is already when there is a lot of economic uncertainty. So there is already big risk premium for other reasons. And the fact that political uncertainty has its own risk premium is going to add up, and therefore even have even bigger impact on a real economy, on the fact that people don't invest, firms find it hard to find funding in order to invest, etc.
But it's not just economic policy uncertainty that impacts the economy. Central banks, such as the US Federal Reserve, the Bank of England, and the Bank of Japan, have a huge effect, and investors carefully parse central bankers' statements to divine their meaning and implications. Even when central bankers try to speak and act clearly, their messages can fuel uncertainty. Professors Drew Creel and Jing Cynthia Wu are digging into just this kind of monetary policy uncertainty.
Our main goal is to understand the impact of monetary policy uncertainty on macroeconomic fluctuations. Okay, so the first thing is you have to define monetary policy uncertainty and then quantify it or measure it. So typically we think about monetary policy influencing short-term interest rates. Okay, the Federal Reserve, through open market operations, kind of impacts the short end of the term structure, and then market participants have beliefs about what future short-term interest rates are going to be, and that influences current long rates. Okay, and long rates are, of course, what we're going to use for investment, right? When we want to take out a mortgage loan, or a company wants to take out loans for investment or projects. So the model we have is a way of characterizing interest rates at a lot of different maturities.
In terms of what causes monetary policy uncertainty, I think there are two parts of it. The first is what is a policy implemented by the Federal Reserve. So for example, recently they trying to promote the forward guidance, and they go through different phases. For some periods, they're very explicit about they think the zero lower bound will stay for 2 years, for example. But for other periods, the phrase is more contingent. For example, it will depend on the unemployment rate, will depend on inflation rate. So those kind of contingents create some kind of monetary policy uncertainty, because there is the uncertainty people have in terms of the future economic conditions. Well, now the second part about the monetary policy uncertainty is how people read about the monetary policy uncertainty. Even though the Federal Reserve could convey that we will keep the interest rate low for another 1 year or so, but whether the market believes in the Fed, that's a different question.
So all that was occurring from kind of 2008, 2010. Struck me as interesting, and I had the sense, and I think a few other people did, that it might be worrisome that there was so much policy-related economic uncertainty. And I still remember thinking that, well, this seems like an important topic, but we didn't really have any hard and fast way to assess policy uncertainty, let alone its consequences. So I just started thinking about, well, this is kind of a squishy concept, economic policy uncertainty. If you wanted to measure it, how would you go about doing it?
In the summer of 2010, Davis met Stanford University professor Nicholas Bloom, and they realized they were both trying to measure uncertainty. Together with Northwestern University's Scott Ross Baker, they started to calculate the level of uncertainty by counting how many times newspapers used key words associated with policy uncertainty. They used that and other measures to create the Economic Policy Uncertainty Index, which today is being used by central banks across the globe, as well as the International Monetary Fund and the World Bank.
We started out with an index that had several components. But over time, we have gradually put more emphasis on the newspaper-based index of economic policy uncertainty. And that's for two reasons. It is more powerful in the sense that it can be pushed back in time, many, many decades, even more than a century, which is what we're in the process of doing now, and also pushed to many other countries. We want to ask the following question. Is the frequency with which newspaper articles discuss policy-related aspects of economic uncertainty, is that a good proxy for how much economic uncertainty there is related to policy, or perhaps better put, how much concern there is among business people, among households, about policy-related aspects of economic uncertainty? So we basically took two approaches. Can we validate the newspaper index directly? And second, does the newspaper-based index that we've constructed, does that have explanatory power for other economic outcomes that we care about?
Baker, Bloom and Davis validated their index by entering it into an otherwise standard statistical model and found that it had strong explanatory power. They then compared it to the VIX, the Chicago Board Options Exchange Volatility Index, a popular measure of equity market volatility, sometimes called the fear gauge.
And the two are very highly correlated. There's some other things we did as well. There's something called the Beige Book, which is designed to provide qualitative, up-to-the-minute information about the state of economic activity in the 12 regional Federal Reserve districts in the United States. It's for the people who make monetary policy decisions. The two sources told us broadly similar stories. There are some differences in the details, but they basically told us the same story, that the last several years were a period that was, within the span of the data, historically unusual or even unprecedented in terms of the size and the run-up in economic policy uncertainty.
Our model predicts that stocks should be more volatile and more correlated when there's more political uncertainty. And we indeed find that stocks are more volatile and more correlated when the Baker, Bloom and Davis index is high. If you engage in political brinkmanship ahead of a debt ceiling, like we did in the summer of 2011, there's a big cost attached to that, and hopefully these calculations will deter similar actions in the future.
The last few years are rather unusual in U.S. history, and they might be the only period in the last half century where policy uncertainty was an important factor influencing economic performance. Maybe it'll continue to be an important factor influencing economic performance on the downside or possibly on the upside. But there are things that policymakers can do to head off the likelihood that policy uncertainty will have harmful effects in the future.
In our research, we find that monetary policy uncertainty will lead to higher unemployment rate, or potentially, in the data at least, it leads to economic downturns. So the policymakers could think about, look at the result and think about when they see the increase of uncertainty, they probably could implement some kind of policies and say, well, can we lower the uncertainty before it's too late?
You are seeing, actually, especially with the influence of Ben Bernanke and Janet Yellen over the last 10 years, an emphasis in the way that they conduct monetary policy and the way they communicate with investors, the public, the market. They're trying to communicate much more clearly and effectively.
Political uncertainty is something that's here to stay. There will always be some degree of political uncertainty. We live in a democracy. We have elections every 4 years, every 2 years if you count the midterm elections. So there will always be uncertainty about who's going to be elected and therefore what kind of policies we're likely to see in the future.